All right. Hello, everybody. We'll be starting soon. Welcome to the 100X show. We have the pleasure of being joined by Muneeb Ali, who's the founder and CEO of Blockstack. He'll be going through an overview of the great news they have coming up next month with Stacks 2.0. So stay tuned. This is going out to Twitter, Periscope, Facebook, YouTube. Also gets turned into a podcast. Be sure to sign up at tokenmetrics.com/podcast, and we'll be starting shortly. Okay, let's do quick shout outs as people are joining. Hello, Master Polo. How are you? Amy C, Bashan, Crypto Gamer. What's up? How are you? We do have a Menti code. So if you have any questions you want to submit for the AMA, please go to menti.com. That's MENTI.com. Use the code 2499330. That's 2499330 to submit your questions. We'll go through and curate the questions for Muneeb Ali. Okay, all right. So, and if you like the video, be sure to smash the like buttons and share the video with all your crypto family. Okay, so let's go ahead and hop into the show. Welcome to the show, Muneeb Ali. How are you?
Oh, thanks for having me.
Yeah, so I was just kind of talking with you offline. I had the pleasure of going to your Mountain View conference back in 2017. And man, it's been a long time since then. And your project has kind of been growing and just doing so well. So kind of give us a quick introduction on who you are.
Yep, happy to, and it was great to have you there in the audience. I feel like crypto was it's still a small industry, but it was even a smaller industry back in 2017. So a little bit about me. I'm a computer scientist by training. So I did a PhD in distributed systems at Princeton University, and before that, almost like for 10, 15 years, I've mostly been doing research work in distributed systems, internet protocols, and that was kind of like my entry into crypto as well. Like in general, the project started off from the computer science department at Princeton, mostly as a very ambitious kind of like project to build the next generation internet, like the more secure core internet infrastructure, right? Like the internet is like a 30, 40-year-old technology at this point, and we were looking to upgrade some of the core internet infrastructure, and discovered blockchains almost like afterwards, right? So we discovered blockchains in 2013. To put it in kind of like Bitcoin terms, Bitcoin was trading at like $90 or less than that at that point. And we discovered blockchains as like a elegant solution to some of the problems that we were trying to solve. And they are mostly around how do you have like global consensus and more scalable decentralized systems through which you can build some core internet infrastructure, but also services and applications on top. And this is before the terms like Web 3.0 even existed. And I think now people have a slightly better understanding of like what Web 3.0 is. It's mostly around these smart contracts and decentralized applications. And I think within crypto, one way to think about the work that we do with the Stacks blockchain is that we are in the Bitcoin camp, like in the sense that if you divide most projects as Ethereum is definitely kind of like the more dominant player right now in terms of apps and smart contracts. So you're either building on Ethereum or kind of like planning to build on ETH2, or there are these new next generation blockchains that might be faster or have their different capabilities, and we almost view them as a bucket, right? Like there are a bunch of these projects, and some of them we are very friendly with, and we collaborate with them and so on. But we are actually building on Bitcoin. Right, so we bring our blockchain has a native connection with Bitcoin. It's almost like it's not really a side chain, but that's probably the best way to understand it. It's a layer one blockchain that has native connections to Bitcoin, and the Bitcoin chain is actually securing the Stacks chain as well, right? So to basically change the history of the Stacks chain, you'd have to attack Bitcoin as well, right? And it should be thought as a project that brings new functionality to Bitcoin. We bring smart contracts to Bitcoin. We actually bring more scalable transactions to Bitcoin. And our core thesis is that just like in the early days of the internet, there were several different types of networks, but eventually we started seeing, people building more on TCP/IP. So Bitcoin might actually become that layer, and we kind of like provide the rest of the functionality that you would need for something like that to happen.
Wow, there's so many paths to go there to delve deeper. I'm already fascinated. Okay, once again, if you have any questions you want to submit, please go to menti.com. That's menti.com. Use the code 2499330. That's 2499330. Okay, so first thing that kind of comes to mind, you're taking a very unique approach of building a blockchain and securing it with Bitcoin. So how did that come about? And then how is that different from other blockchains like Rootstock or Riff, who also have been trying to build on top of Bitcoin?
Yes, so I think it might be worth spending a little bit of time here. I would say that this question is probably one of the most fundamental questions in crypto, and a lot of people face that, right? Like I'll give you my example. Like back in 2013, when we were looking at this additional functionality that was not there in Bitcoin, we almost had like a couple of choices. One is that you try to somehow add that functionality to Bitcoin, right? Similar to how even Vitalik started trying to propose smart contracts on top of Bitcoin, soon realized that Bitcoin core developers are not going to do that, and he went off and built Ethereum, right? Or you try to build on something that has a connection to Bitcoin, like a merged mine chain, like Namecoin used to be around. And I think RSK is similarly in that camp, where their blockchain is merged mined with Bitcoin, and they kind of like try to have almost like a Solidity language or EVM functionality on the merged mine chain, right? Or the third option is that you just basically build a separate blockchain, which is the option that Vitalik took, or some of the new projects that we're seeing these days. They're mostly like almost by default, they try to build a disconnected separate chain, right? And we always remained in the camp that we think that there will be a lot of experimentation that will happen on these independent blockchains, but then there might be consolidation down the road, right? And our thesis is that there's a higher probability of consolidation happening around Bitcoin versus consolidation happening on some other ecosystem, right? And that's and taking that lens, the first iteration of our blockchain was actually literally on top of Bitcoin, right? It's like a virtual chain that runs on top of Bitcoin. That's a system that's live today, but it's a fairly limited system compared to Stacks 2.0, which is our master design, which is the thing we've been working on over the last 2-3 years or so. And in the sense that Stacks 2.0 introduces smart contracts around Bitcoin, right? So I think that's the key thing. That smart contracts is the functionality. Like imagine all of the different types of applications like decentralized exchanges or lending protocols or all the innovation that's happening. It's mostly enabled by having smart contracts directly as a feature on a blockchain, right? So which Bitcoin doesn't have, and for good reason it doesn't have that. But I do think there's a place for that to enable it in a more secure manner, so that you're not compromising the security of the base layer, but are adding it as almost like a separate thing next to Bitcoin.
Okay. Now, how does this compare with other projects that are trying to tackle the same issue?
Yeah, so I think in terms of a mental model, I would say that think of Stacks 2.0 as almost like ETH2, but just like ETH2 would kind of like depend on ETH1, we depend on Bitcoin, right? And similar to kind of like ETH2, where people can stake and earn ETH or ETH2, depending on if you think it's a different token. Over here, if you're participating in consensus and you're locking up STX, you're actually earning Bitcoin, which is a very interesting property of the asset, because I think it's the first asset where if you lock it in consensus, you actually earn another asset, and that it's not just any other asset; it's actually Bitcoin. And I think a lot of people view Bitcoin as being valuable, and they want to earn more of it, right? So that's kind of like one difference. The other thing is like if you take a step back, I would think that the biggest or the hardest thing that any cryptocurrency would face is the fight to be a reserve currency or a sovereign money, right? and Bitcoin in my mind is like far ahead. Also because of like the way it was launched, the kind of community it attracted, the things like fixed supply and some of the other characteristics of Bitcoin make it probably the best suited crypto asset that can be sovereign money, right? And sometimes we see that kind of like play out in the ecosystem where people are saying ETH is money, or some other project is trying to become money. I would say trying to become money is probably the hardest thing. So we don't compete with Bitcoin over there, right? So we are not saying that Stacks is going to be money or Stacks is going to be a sovereign currency. We accept Bitcoin as the sovereign currency, and we add the additional functionality where Stacks can be used within smart contracts around Bitcoin, right? So in some ways, it's a more limited scope, and the asset actually grows in harmony with Bitcoin instead of trying to compete with it, right? Whereas,
Yeah. Now,
yeah,
we know there are lots of Bitcoin maximalists out there. How do you kind of appease them by launching a blockchain building on top of it with its own cryptocurrency?
yes. So I think there's definitely a spectrum, and there are some people who are effectively like there should be just one asset and no other asset. But if you start having a discussion with them, the Bitcoin maximalist would be of the view that they view Bitcoin as a measure of true value, right? But they think that the dollar should be priced against Bitcoin, or other types of commodities should be priced against Bitcoin because their real value should be measured against Bitcoin, right? Versus anything else, right? So if you play that out, Stacks is actually one of the first cryptocurrencies, or the first cryptocurrency that effectively has a price pair against Bitcoin natively on the Bitcoin blockchain itself. The main pair comes from how mining is done, and people mine the chain by using Bitcoin as proof of computations, right? So it's almost like a BTC STX trading pair that happens on the Bitcoin chain itself. So STX is natively priced in Bitcoin, and it's fuel for smart contracts. So what we're saying is we are accepting Bitcoin as a reserve currency, and our price on the Bitcoin blockchain is the most precise measure of what is the value of our asset, right? And if you play that out, you should have more assets that effectively accept Bitcoin as like, hey, my base price pair is represented in Bitcoin. And then you start kind of like getting into other arguments where imagine that, if you hold Bitcoin and you're a Bitcoin maximalist, you don't want to sell your Bitcoin, but you might be interested in taking a USD loan against your Bitcoin holding. And right now, you either have to go to centralized parties to be able to take a loan like that, or you might have to actually use something like wrapped Bitcoin and go to a Ethereum smart contract and try to take a loan that way. Whereas we are enabling that type of functionality through smart contracts directly around Bitcoin, meaning that in a more decentralized way, on a blockchain that is actually secured by Bitcoin, you can take a USD loan out, right? And those things, like once you have a discussion with the maximalists, like they start seeing that. They're like, okay, I would rather take a USD loan through a system like this versus going to Ethereum or versus going to a central company and using that instead.
All right, sounds good. So once again, if you have any questions, please go to menti.com. We have the questions coming. We'll go through and curate questions in a bit. So go to menti.com, menti.com. The code is 2499330. So let's change topics and talk about the Reg A Plus offering you had last year, which was really monumental for crypto, especially for a US company. Kind of walk us through the reasoning of doing that and the pathway of getting the SEC's not endorsement, but approval of the filing.
Yep. Happy to. So, to give people a little bit background, we got the first ever SEC qualification for doing a token offering last year. So it was a public offering. We wanted to kind of like include everyone. And the rationale for that was effectively two things. First is that when we were kind of like launching our plans for building this blockchain, and we wanted to distribute the crypto asset to people who wanted to participate. Looking at the regulations, it really seemed like we cannot let the general public participate. This is 2017. This is around the time of the Blockstack Summit in Mountain View. So what we did back then, it really bothered me that our core community and some of our open source developers or just the general enthusiasts around the project won't be able to participate because of regulations. And obviously we want to comply to all applicable law. So what we did in 2017 was we did an offering that was open to accredited investors and large institutions, but we also gave everyone who wanted to get a voucher. It was a non-binding type of a voucher that you will get the same price for participating in the offering once we figured out how to do an offering with the general public, right? So that was really our way of, it just didn't feel right that, institutional investors can purchase right now, but the general public cannot, right? So we just gave them these vouchers and we said, we'll try to work on this problem. And looking into the regulations, I know there has been lots of kind of like different frameworks and different people saying that, hey, these things are not securities and this and that. It was at least very clear to me that the SEC is going to come in and basically effectively say that most of these things are securities, or at least they're securities at the time of launch, right? And complying with the regulations was definitely the harder thing to do, but it also helps us sleep better at night, right? Like in the sense that, you have the comfort that you're complying with the applicable law, and it has some benefits as well. Yes, there's a lot of overhead. Like we had to figure out all these legal frameworks, all the accounting frameworks, and no one had done it before. So we really had to figure out new ways for how to do it. But then during the process, you're actually doing a lot of public disclosure, which I actually think is a good thing, right? Like maybe there should be some easier way of doing such disclosures versus the kind of expense and complexity that we had to deal with. But these disclosures actually mean that anyone who wants to hold the stacked cryptocurrency actually has 180 pages of information on who the company is, what their financials are, who the directors are, who are the key employees, and what are their holdings, what are the main business, even our business contracts are publicly available, right? Like if we got a listing on Binance, like what agreement do we have with Binance is publicly available. So we are holding ourselves to these standards of a company that almost like goes public, like does an IPO. And we do periodic filings, like all of our financials and reportings, even today, right? So we did the offering last year, and we have been treating the asset as if it's a security in the US, even though even in our offerings, we say that it's a utility token, it gets used in smart contracts, like it has a network use, but we're just being extremely cautious and careful to treat it as if it's a security.
One thing, so just to kind of jump in here, because I did go through the offering because it was pretty important when it launched, and that's something actually our own legal counsel as well found very interesting. Even though you went through the filing, you never really agreed that it was a security. You said that you're following the laws in the US. However, you still believed it was a utility token.
Yes.
What was the process behind that?
Yeah, because I think like in terms of what the token is, it's very similar to ETH, right? Like it gets used for transaction fees, it gets used for mining incentives, it gets used for smart contract execution, right? So it's like, and the token is a utility token in the sense of like people use that on the network, right? It's not a equity in any company, right? However, the interesting thing here is that if you use the Howey test, there are different kind of like conditions where, hey, is there a dependence on a single company, right? Or other types of things that might trigger that you should treat it as if it's a security for the time being, right? And especially if you want to be more careful, then the more safer thing to actually do is comply with the securities regulations anyway, right? Just in case, just to be extra careful, so that there aren't any problems down the road. So we actually took that framework that, let's say that at best it's unclear if it should be treated as a security or not in the US, right? So how about we treat it as if it's a security? And then internationally, most of the legal opinions are like they already treat it as a utility token. And that's how it's treated. And that's why it trades internationally already. And then interestingly, with the launch of Stacks 2.0, we released a legal framework and a memo from Wilson Sonsini that basically says that with 2.0, there's actually very little reason to treat it as a security anymore, right? Like, in fact, all of the analysis now points that it's very clearly not a security upon the launch of Stacks 2.0. So what that does is it actually, for the first time, gives a explicit framework for how something can be treated as if it was a security. And then it can explicitly be have this transition to a non-security status. And that's a question that the entire industry has been grappling with over the years, where people just don't know how can these things transition to clearly not being securities.
Now, where can we find the framework you mentioned by Wilson Sonsini?
Yeah, so it should be on a blog.blockstack.org. And I think I tweeted out, there was a story in Reuters about it, and then I tweeted that out as well. I'm on @Muneeb, MUNEEB, my first name.
Yeah, because that would be very good to kind of see. Now, you and Props Project are the only blockchain companies, to my knowledge, that have gotten approval. Ironically, both of you are also backed by USV, Union Square Ventures. Now, any idea as to why no other companies have been approved? Do you think it's because of the legal reasons? Legal expenses of going through that entire ordeal? And any idea in terms of what the typical timeline is?
Yeah. So I think one thing that we've seen is that in the industry generally back in 2017, a lot of people were using these SAFs, and I was not comfortable with it. I kind of like stayed away from that structure. And interestingly, if you notice in the last couple of years, people by default just block the US investors now, right? Which, if you think about it, that do you want to go through, 8-9 months of a process with the SEC and get a qualification to open up the network to US general public versus just block them? Blocking them is a much simpler, easier decision, right? And a lot of people are kind of like doing that, right? So in several ways, it's a shame that because of the overhead required to get these qualifications, people are effectively blocking off the U.S. investors, and it's in the long run, I think it's actually bad for the U.S. public, and there's a need for easier frameworks or cheaper ways for people to actually open up to the U.S. public markets as well. For us, like it was a little bit of a question of given that the project started in the U.S., we were based out of New York, or we had very heavy links with Princeton University, and some of our early backers ended up being U.S. investors as well. And it just felt very weird that most of our open source community and developers who are building are US people. Obviously, we have some international participants as well, especially back then. It just felt strange that we block all of them off and just open to international people. So we fortunately had fundings and investment to be able to spend on this offering. And our hope was that once we do it, hopefully it will become cheaper and a little bit easier for other projects to do that as well.
Okay. Now, with the launch of Stacks 2.0, you're becoming fully decentralized. Kind of speak to the regulation around that, right? Because the SEC hasn't officially given you a no action letter. So what makes you confident in terms of this not being a security? Are you following different guidelines?
Yes. So I think it again comes back to the how we test analysis, because the SEC falls back to it, right? And let me give a little bit of a background there. So it's basically a court case where there was a orange grove, and the question was about, are these investors, they are relying on a company for profits from the orange grove. Oranges themselves, they're not securities, right? They're just oranges, right? It really, the analysis is around what role a company is playing in a structure where someone is kind of like putting money in with the expectation of profit, that where somebody else takes an action and people are expecting to make a profit out of that. And I'm overly simplifying it for the audience, but they can go and kind of like, look at the details. So interestingly, the stacks token is just computer code, right? And people use it on the network. It's a little bit like oranges. Like I'm eating an orange. Like this is not a share in the company that I'm eating, right? It's just an orange. Similarly, the Stacks cryptocurrency itself, like I can consume it in a smart contract. It gets used. It actually gets used, and the smart contract executes when it's an input, right? The question is more about the state of the ecosystem. That is there like a single company behind it that is promoting this network, or people have an expectation of profit based on the activities of that company. So most of our legal analysis is around the facts on the ground, basically saying that, so my company effectively did the early R&D and development of the public infrastructure. I think an analogy there would be if Satoshi was a group of people, which is possible that it was a group of people, the time when Satoshi was actually writing the code, they were more in control of what the network is, right? And they could decide when to launch it or what features go in or don't go in. But Satoshi never took money from anybody, right? He just kind of like launched the network, and then independent miners came in and started running the network. But Satoshi was a miner himself, or the group was a miner as well. In our case, we're actually being extremely careful over here as well. And we are saying we will not be a miner. We are releasing this code base, and then our work is done. And we've been very vocal about it. We've been telling our ecosystem, there have been several independent entities in the ecosystem as well, whereas our company rebranded to Hero, and we will be building kind of like developer tools on top of the blockchain, right? That is a very well-defined narrow scope of the work that our company will do. And we are publicly saying we're not building the blockchain anymore. We are not responsible for running this network. Independent miners are going to run it. If there are future changes to the network and the protocol, there's an independent nonprofit now that kind of like helps take in proposals for improvements. Miners have to vote on these proposals, just like in Bitcoin. We have a very high threshold. So it's really an analysis of the state of the ecosystem, that how much dependence is there, like after the launch, what role is this company playing in the ecosystem, and how much dependence is there on this particular company in the ecosystem. And our legal analysis just goes through all the facts and basically says that, this company is like a developer on top of a blockchain and does not control the blockchain, does not materially impact the cannot materially impact the blockchain.
Now, what happens to the company tokens, for example, right? Kind of tell us about that in terms of not being decentralized or being part of the ecosystem.
Yes. So I think we, obviously, because we built the technology, like we had these token offerings where people could buy the asset. So in 2017, the people could buy the asset for like 12 cents, right? And then in 2019, because the network was kind of like more developed and there were more applications on the network as well, people bought the asset around 30 cents, right? And our company effectively had an allocation for ourselves, but in the grand scheme of things, that allocation is actually fairly small, like in the sense that, and it's also locked up for a very long amount of time, right? So our company would at no point have more than 15% of the asset. And in effect, at any given time, the number of liquid tokens with us would be even smaller, because we get unlocking over 7 years. And a lot of that unlocking would actually start next year and then play out over the next 4 years. So our company would have a small fraction of a liquid asset, and yes, more will unlock over time, but even the total number would never be more than 15%, which if you compare this to something like Ripple, where the company is sitting on 80% of the asset.
Now, I mean, could one assume, maybe, obviously not legal advice, but if the SEC were to view a company that owns less than 50%, where the majority is owned by the community? Let's say 51%. Could that be decentralized then?
I don't know. We ended up picking, so it's 15, it's 1.5, right?
15. Okay.
Yeah. So it's very small, and most of the time it will be less than 10% even because of the unlocking schedule. So I don't think there's a magic number, but in general, I think there's some guidance from the public markets where, let's say, if you hold more than 10% of a public company stock, you might trigger certain requirements, right? So in general, I think because the kind of like 10 to 15% range can roughly be derived from some of those guidance in the public IPO markets.
Okay. All right,
Yeah,
let's
50,
take a question
50,
from
50 would be a very high number in my view.
Yeah. Okay. Let's take a question from the audience. So the question is, who are your main token holders? What are their demographics, and what steps have you taken to widen that?
Yes, so I think in the early offerings, it was a lot of sophisticated investors, right? So Union Square Ventures, and this is disclosed in our SEC offering. Union Square Ventures is one of the largest holders. For people who don't know who they are, they were really early investors in Coinbase, like Twitter, MongoDB, Twilio, a lot of developer tools. They've taken companies public, and they're regarded as one of the top investors in the world. And then we have other funds like Lux Capital, which is like a science fund. They manage around $3 billion. Foundation Capital, the Winklevoss Capital, the Winklevoss twins, Blockchain Capital, a lot of these sophisticated investors, plus some institutional investors as well, like even endowments, and people can go and find information there. So the early investors, I believe there were more than 800 who participated in 2017, and they tend to be generally US based. I would say more than 80% or maybe more than that were US based, and they tend to be more traditional top tier funds and so on. And then I think a couple of things that we realized. One was that we noticed that it's very US heavy. So in 2019, we explicitly went out to Asia and other parts of the world to include investors from there as well. So in 2019, our offering was almost like designed to balance out the earlier offering and bring more diversity in, right? So we got a lot of Asian investors in at that point. Hashkey, that's it's a very sophisticated fund out of Asia. Fembushi Capital, SNZ, Recruit Holdings, which the Recruit is an internet giant in Japan. They're worth around like $50 billion over there, and so we got some sophisticated investors from Asia. And then we focused more on retail investors, right? So because we did the SEC qualified offering, a lot more people were able to participate, right? Both from the US and internationally as well. And at that time, I think we got around 4,500 people to participate in 2019, which at that time was the largest sale ever on CoinList. I believe now there's one other project that has done a larger, in the sense of like more people participating, sale recently, but I think for the longest time, that was the biggest sale that happened on Coinbase.
All right, thank you. Okay, let's now switch to a question regarding DeFi and 2.0. So the question is, will stacking 2.0 have impermanent loss when stacking STX as a liquidity provider to farm Bitcoin?
Yes, so I think there are a couple of things there that I should separate out. One thing is that Stacks 2.0 uses a very different consensus mechanism. It's actually consensus between two blockchains. It's consensus between Bitcoin, which is kind of like the base chain, and the Stacks chain. And Bitcoin miners on our system, they actually mine on the Bitcoin blockchain, right? And they mine using Bitcoin. And the best way to, in my mind, the best way to model mining for us is it's kind of like a BTC STX exchange pair directly on the Bitcoin blockchain. Miners are bidding in Bitcoin. So a new block is coming out and they see what is the value of this block. And the value is the newly minted STX, the Coinbase rewards, plus the transaction fees and the smart contracts that are executing, right? So they know that some amount of STX is up for grabs. and they can actually bid and live. There's a live bidding mechanism on the Bitcoin blockchain, and there's a verifiable random function that picks one of the miners that was bidding. And over time, they figured out, what's the probability for them to win the bid, and they will only mine if it's cheaper for them to get STX from the BTC STX trading pair on Bitcoin versus a Binance or an exchange. In some ways, just like a DEX, right? Like you will only make a trade on a DEX if it's cheaper for you to do it on the DEX and then do some sort of arbitrage with the centralized exchanges and so on. So our mining kind of works that way. And in the process of doing the Bitcoin bidding, because you're sending Bitcoin transactions, you're actually securing the Stacks blockchain data on the Bitcoin chain, right? So that's how we designed it. The Stacks holders are different, right? Stacks holders, it's very different from proof of stake, where you're not processing blocks, your funds are not up for slashing, you don't have to worry about funds getting slashed during the process. You basically lock up your STX and you periodically broadcast certain useful information on the network, right? And you can either delegate or run a full node yourself, right? And when you do this, you're getting a Bitcoin reward on your STX holdings, right? Which is very interesting because the Bitcoin that the miners were using to bid, it's actually going to the STX holders, right? So if the smart contracts are taking off, meaning more smart contracts are getting used, the STX holders are getting a higher yield than Bitcoin. So we released a model that basically plays with these different variables. And I think if, let's say one variable is how many STX are participating in consensus. Let's say 50% is, and then there are some other variables around how many miners there are and so on. Even if you take a lower value of STX transactions and the smart contracts, you can get something like a 9 or 10% yield on your STX holdings, because it's mostly driven by the Coinbase rewards, the new STX that's being introduced in the system. But if you start getting more smart contract usage, which is the main thing we're trying to do, we're trying to bring all the different smart contracts to Bitcoin. Then because the value of the block goes up, that means the miners are willing to bid higher for those blocks, and the value is actually going to the STX holders who are participating in consensus.
Okay, that's definitely very fascinating. So tell us what you think. To all the audience watching this, be sure to post your comments and thoughts down below. I am going through them and trying to bring them up into the interview. Okay, all right. Let me get a few more questions here. Next question, who are current key partners and who are you looking to partner with in the next 12 months?
Yes, so I think we are in a unique position where we are in the CoinMarketCap top 100 asset. I think we're in the 70s somewhere right now. But we do full SEC filings, right? So our company still, follows the SEC regulations, and any kind of like major business contracts, they get disclosed with public filings. So in general, I cannot comment on future things, right? It's like one of the big things in following these regulations is public information should come out like in one go, and everyone should get that information at the same time. So I can't generally comment on what will happen in the future, but I can tell you the stuff that's already public, right? So what's already public is staked.us came out, and they said that there will be a launch partner for the Stack 2.0 chain. You can use them as a delegation service. Like if you want to delegate we call it stacking, right? It's similar to staking, but you want Bitcoin there. If you want to delegate to them, you should go and talk to stake.us. Recently, Chainlink came out, and they said that we will effectively have oracles available after the Stacks 2.0 launch, because once you have smart contracts, oracles become very important for these developers. And for our smart contract language, we didn't get to discuss this, but we have a new language called Clarity, and that is really focused on security. It basically gives formal proofs of correctness for these programs, meaning that a lot of problems we have seen with Solidity or funds getting hacked or these re-entry problems. It basically targets a lot of these things and brings that functionality to Bitcoin. Algorand came out and they said that they are partners in developing the Clarity programming language, and they can try to run that language on the Algorand chain as well, right? And then recently, OKCoin, which is a sister exchange of OKX, focused mostly on the U.S. markets. They came out and said that upon the launch of Stacks 2.0, they would be a launch partner and basically start U.S. trading as well. So these are some of the recent ones that came out publicly that we can discuss. But in general, people should stay tuned for more announcements. As you can imagine, the mainnet launch is the biggest event that has ever happened in the history of the project. So we have an entire launch event, and it's very exciting, and you'll get to hear more updates as we get closer to it.
And that's on the 14th of January?
Yeah, it's 14th of January.
All right. Okay. Next question. Let's go back to DeFi. DeFi has really been the biggest trend this year. Uniswap, Compound, all these projects have been really doing well. And we also have DAOs kind of becoming a thing. So when the project Blockstack is becoming decentralized, who will govern the project, and how do you plan to possibly bring DeFi developers onto the blockchain?
Yep. Let me first answer the DeFi part, right? And I do think that in general, there are two tracks in crypto, and both are very exciting. One is these financial products like decentralized finance, DeFi. The other is these more general purpose applications like, decentralized social networks or decentralized blogging platforms and so on. And I think in many ways, we're noticing that the DeFi apps are finding product market fit like now. Like we are seeing early signs of like them taking traction like today. Whereas I do believe that maybe in a year or two, or the other more general purpose decentralized applications might also start finding more better product market fit and more usage. But as of right now, as of today, all signs point to the fact that DeFi applications might be getting more traction. And we are very excited that we didn't plan this. Like we've been working on Clarity for almost like 2 years, but Clarity brings DeFi to Bitcoin effectively, right? That's the new programming language. In that programming language, imagine that because of our tight connection with Bitcoin, the Clarity smart contracts actually have full visibility into Bitcoin state, meaning that developers can now program against Bitcoin state. I as a developer can write some piece of code that says if X amount of Bitcoin goes to this address, trigger something in logic, right? Like you could start programming against Bitcoin movements, or you can more easily move Bitcoin, the asset, directly into the Stacks chain and start writing programs against it, right? So imagine that right now, Uniswap or a lot of other applications, they're great, they're taking off, but they're mostly taking off in the Ethereum ecosystem, right? And a lot of trading pairs are against Ethereum and so on. Whereas in the broader market, the Bitcoin trading pairs and liquidity is actually higher, right? So imagine that the work that we're doing, it's actually bringing these decentralized exchanges or these lending applications directly to Bitcoin, where you can have these trading pairs on chain, on the Stacks chain more easily directly around Bitcoin versus some of the more disconnected blockchains. So that's generally about DeFi. Like I think we couldn't have timed it better that our blockchain 2.0 is launching now that actually enables smart contracts. Like we've been working on it for 2 years, but this is probably like the best time to actually launch that functionality around Bitcoin. And then for the second question about governance, I think it's a very, very important question. And in general, the way we treat this is we roughly follow how Bitcoin works, right? Like our blockchain actually, even the halving events in our blockchain, they follow Bitcoin, right? They halve when Bitcoin halves. And we have a similar mining threshold that you need, 80% of the miners to signal support for a change, for that change to actually go in. And but we do have this nonprofit, the Stacks Foundation, that has nothing to do with my company, by the way. This is not one of those instances where it's the same people involved in multiple entities. Like we are very careful about having independent entities. So the independent Stacks Foundation becomes almost like their focus is on helping people with these research proposals if they want to propose a change to the protocol. Like they can collaborate, they have various working groups on governance and so on. It's a very open, community-driven type of a setup, and people can participate there, but eventually miners get to vote on these changes just like on Bitcoin, right? So if a new BIP is going to get adopted, miners get to decide that is it going to adopt or not. And that's the process that we plan to follow with Stacks 2.0.
All right, that sounds great. Let's take a few questions here from the comments. Okay, is there a minimum amount of STX required to stake to farm BTC?
Yes, so I think there is a minimum amount. Let me give a little bit background about it. The minimum amount is actually triggered because of the bandwidth restrictions on Bitcoin, right? Because these transactions happen on Bitcoin. When you're earning Bitcoin, you're actually, there's a transaction on Bitcoin where money is like going to your address, right? And we cannot just completely take over Bitcoin and have, like imagine we have, 5,000 people participated in our offering, then around 300,000 people participated in a blockchain.com airdrop. So we can't have like hundreds of thousands of people saying, send me a fraction of the Bitcoin, and that transaction actually happens on Bitcoin itself, right? So we had to kind of like rate limit it. And the way we do this is by having a dynamic threshold, meaning that depending on how much of the liquid supply is participating, there is a minimum amount of STX required that can have a single Bitcoin address as a payment address, right? So the protocol can effectively take, you should think of that as like roughly 4,000 addresses in a reward cycle. A cycle is for two weeks, and we could take like roughly 4,000 addresses. So we do the cutoff based on the threshold. With that said, people can form pools. There's already native support for delegation. You can delegate to somebody, right? And when you're delegating, your funds are not at risk, right? You can keep your funds in a cold wallet. You can delegate to a pool or to a provider, and then the provider on your behalf can participate in a round. So the risk that you're taking is just for a 2-week period, you're kind of like trusting the provider that they're going to earn the Bitcoin on my behalf and then give me back my Bitcoin, right? And to make the answer a little bit more concrete, I think if you assume like 1 billion tokens as the supply that's unlocked on day one, right? So I think the total number of tokens is around 1.3, but some of them that belong to the team and other people are still locked. Let's say roughly 1 billion might be unlocked in total when Stacks 2.0 launches. If 50% of the liquid supply is participating, the threshold might be a little bit higher. If 25% is participating, the threshold might actually be a little bit lower.
Okay, so to add on a follow-up question to that from Naveen on YouTube, why is the coin supply unlimited?
So I think the main thing over here, just to put a finer point there, I just pulled out the numbers. So I think if 25% of the supply is participating, then the minimum threshold would be 70,000 stacks if you want to directly participate, meaning that you're running your own node and you say, here's my Bitcoin address, and Bitcoin rewards can directly come to it. If 50% is participating, then the minimum would be kind of like around 130K stacks. And otherwise, you'll need to pool together to get to those numbers. Now, the second question about the supply, I think the way to think about this is, I think it's great that Bitcoin has a fixed supply. It just makes things very, very simple. But in general, like there is a question of like, why would miners mine your chain if they don't have kind of like these Coinbase rewards? So we have a kind of like a set schedule for what is the total number of tokens that will get released over time. And that inflation rate is actually fairly low. It's less than 1%, right? So by year 2050, you would roughly have 1.8 billion tokens. So you'll go from 1.3 to 1.8 slowly over 30 years. And then it will kind of like keep on increasing slowly, but it's a incentive.
Inflationary, kind of like Ethereum?
Yes, it's kind of like Ethereum, but the rates are set. So the rates are very clear that this is the rate and it's not going to change, and it's kind of like hard coded. You need miners. It's very hard to make a change just like in Bitcoin, right? Like we kind of like follow the Bitcoin method of making changes there.
All right. Okay, so if you're enjoying the live stream, be sure to smash the like buttons, share this video with your friends in crypto. Also tell us what you think about the project. Muneeb, so when we come on the show, we like to put our guests into the lightning round, we call it, or hot seat. So we have 3 questions we'd like to ask you. The first question is, what are your 3 favorite books that have changed your life?
I would say one of them is Snow Crash. It had a huge impact on me. In fact, a lot of the concepts in Blockstack, even the name of the company, we rebranded to Hero. So Hero is a character in Snow Crash, and I think it's one of my all-time favorite books. I recently, instead of saying favorite, I would just say 2 other recent books I've read. One is Bitcoin Billionaires, in which the Winklevoss brothers are there. That was just a fascinating view into the early days of the industry. And I am reading Too Big to Fail these days, which is a very interesting book by Sorkin, and he effectively goes into the details of how the financial industry collapsed in 2008. And I think there's actually a connection with Snow Crash, which tells you about the future, and then Too Big to Fail, that how the financial industry collapsed, and Bitcoin Billionaires, which is about the start of the new technology that might lead us to a snow crash like world in the future.
All right, awesome. We'll check that out. Okay, next question. Past or present, who are 3 people who have inspired you or helped mold your life?
I would say I would stick to the present, stick to the people I already know. I would say one of them is this professor at Princeton, Professor J.P. Singh. He's actually on the board of the company with me. I consider him a personal mentor. So over the last 10 years or so, I think any kind of like big decisions or kind of like just like he's an extremely intelligent person. He did his PhD at Stanford with John Hennessy, who's the president of Stanford. And over the last like several years, he's just an extremely smart person to serve as a almost like someone to brainstorm ideas with. And sometimes he helps you like, pop up a level and take the bigger picture in mind versus being stuck in something very, very small. And I find that very, very helpful. I think out of our investors, I would say Naval Ravikant is an extremely sharp person. I think you were there when we had the fireside chat at the Blockstack Summit, but any interaction with him and brainstorming ideas about what we are doing with him are amazing. Same with Balaji, like he's a friend of the project. And a lot of the ideas like, that you see getting rolled out in the Stacks ecosystem sometimes are triggered by a conversation with Balaji or Naval or so on. And that's always very fascinating that, you could take their brain power at times and actually direct people in our ecosystem or developers that, hey, there might be something interesting here, and then actually see that come to life. And I think being able to do that is actually fascinating because we can build the tools and bring these ideas to life.
That's awesome. Definitely very well-known people in the space. All right, last question. What are 3 actions you've taken that have transformed your life?
I think the actions actually would be, I'm pretty much like obsessed with like being productive. So in grad school, like, I would sleep less, I would just like work myself to death and whatnot. And recently I've actually started meditating, sleeping better. And I think a lot of these things are actually making me more productive. And it's a little bit counterintuitive that you're taking time out from your day to meditate or journal in the morning, or you're actually sleeping longer hours, or you're trying to be more careful about your sleep and you're measuring it, but it feels like you're taking out time from the 24 hours, but you're actually making your day more productive, right? And those are the kind of things that I became really obsessed with. I have all sorts of trackers to track my sleep and my productive hours and my focus and things like that.
Any other actions? Two other actions you've taken?
I think recently, especially with the decentralization of our ecosystem, I am trying to step back a little bit, right? Like I'm trying to let other people in the ecosystem kind of like fill the gaps and actually emerge more as leaders in the ecosystem, which is like a little bit of a conscious effort from my part, but it's also very liberating because it actually helps scale out things a lot more, right? I as a single person cannot do everything, right? So both realizing that for this ecosystem to be strong, you need a true ecosystem and not just kind of like one person or one entity trying to do a lot of the work. But by doing that and by seeing like how amazing our community is and how much work and responsibility they've just taken on naturally by themselves, right? Like they're responding to that call and they're really stepping up, and that's just fascinating to see. And in many ways, like it turns out that I was needlessly worried about certain things where it's like, no, we need to do this and that, and whereas you need to empower other people to help build a open source decentralized protocol. Like it's very different from building a company where kind of like the typical CEO is like taking on more and more responsibility or hiring and so on, whereas this is all about taking a back seat and empowering other people to actually do some of the amazing things.
All right, that's great. Okay, do you have any last words as we wrap up the show? Anything else you want to cover we haven't touched on?
Yeah, I would just say that I know a lot of people know the project because of our compliance, which is a little bit interesting because we are a bunch of computer scientists and engineers, right? Like our bulk of the work is actually on the engineering side. But I think if there's one takeaway people can take, that might be that just like we did a very, very thorough job on the compliance side and went above and beyond the requirements and making sure that we are sitting on solid foundations. Imagine that that's not even what we do. Like I'm not a lawyer by training, but I am a computer scientist by training, right? And most of the people we have hired, they're really computer scientists by training. So the work we have done on the design of the core consensus algorithm, the smart contract language, the connection to Bitcoin, I would say that I'm extremely proud of the team. And we've kind of like, it's a similar DNA. We have taken the harder path, but the right path. And we have taken our time to make sure that we are at a very solid foundations. And Stacks 2.0 is like by far the biggest launch we have ever done as a project. Like nothing else even comes close. Like it's actually the in several ways an end to a several year journey where now the public infrastructure is ready. Like imagine like ETH2, right? Like people have been working on it for 4 or 5 years or whatnot, right? And it's going to launch at some point. And that's happening for us now. The Stacks 2.0 is our master design, but it's ready to go. It's built. Mainnet launch is like 26 days away now. So I would say I'm extremely proud of what we have done, and I would ask people to take a look, try to play around with this, try to understand the economics, the Clarity smart contract language, the consensus mechanism, and watch out for the launch and try to learn about it.
All right, sounds great. And if you enjoyed this interview, be sure to smash the like button, subscribe, share this with your friends, and tune in. So that being said, thank you so much, Muneeb Ali. It was great having you on. And as we like to say, the moon is not the limit, to the moon and beyond. Thank you, everybody.